Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about your tax problem that you don't realize that you have. And this is an issue that I would say 100% of our clients face, especially in the first 1 to 3 years of retirement. So I'm going to break down that tax issue, how you can prepare for it and kind of map out to make sure that you don't kind of run into this roadblock as well, and just mentally prepare as you get closer to retirement. And maybe you're already in retirement and facing this and you don't know how to kind of sort through it. So this video will break down the numbers and help you walk through this process. So what's the tax problem that you have? Well, it comes to retirement and moving from one income stream, i.e. your paycheck that comes into your bank account every 2 weeks or twice a month, to multiple income streams. Might be a RRIF, a LIF, a pension plan, CPP, OAS, TFSA, non-reg, many other things, rental income. There can be a long list of things that are driving income for you. Some of those things are taxable, some aren't. Some have withholding tax, some don't. And having all these different income streams creates a lot of chaos and a lot of uncertainty around how much tax you should be paying, tax time, especially again, the first 1, 2, 3 years of retirement. As you come up to tax time here, do you know, are you going to pay tax? Are you going to get a refund? What is your tax situation? And if you're in the first 1 to 3 years of retirement, you probably have no idea. And so what you need to look at is all of your income streams. Again, when you're working, it's really easy, right? You show up to work, you go home, they pay you your paycheck every 2 weeks, and they give you the right amount. And typically, all things being equal, when it comes tax time, you're either going to get a very small refund or pay a small amount. But typically, for most of you, it's pretty much on par, unless you have something, big union dues or RSP deposits or whatever it is. For most of you, all things being equal, there's not much of a refund or a payment. But in retirement, because you have so many income sources, each income source looks at itself on an individual silo. So your pension plan, let's say you have a pension and it's giving you $25,000 a year. That pension plan assumes that that's the only income you have for the year. So it taxes you accordingly. And then let's say your RRIF account, you need to pull $25,000 out of there. Well, there's a withholding tax on there. It might be, depend how you take it out and what your RRIF minimum and all that, it might be 10, 20, or 30%. Again, if it's 30%, that's probably higher than your average tax rate. CPP and OAS, I know for a lot of people, opt out of withholding tax. So you're getting all the money, but you have to pay tax at tax time. So again, there's a lot of moving parts, and this is for everyone as they enter retirement. You go from one income source to more than one. And again, even if you've saved nothing, you have CPP and OAS. So you have double the income streams that you did before retirement. So again, that complicates it. It may not be a lot of money, but it still complicates it. Now, part of our financial planning process that we go through for our clients is breaking down, obviously, maximizing after-tax income, reducing the tax bill, creating a strategy around that taxes. But there's a lot of side benefits to having a proper plan put together. And one of those is understanding A, where all your income sources need to come from, but B, how much tax you're going to pay. And then we can work backwards to figure out how much withholding tax there is, how much tax you're going to have due, and at the end of the day, if you're going to have a tax bill or not. I always say, it's never a bad thing at tax time to have a tax bill, right? That means that you've been able to hold on to your money for longer. Like if you've maximized your tax strategy and you still have to pay tax, which most of us do, if you have to pay a bit of tax at tax time, it means that you've been able to hold on to your money until tax time. If you get a refund, that means the government was holding on to your money and not you, which I think is a disadvantage. So again, I don't mind a small tax amount owing as long as you know you're going to owe it. I think there's nothing worse than doing your taxes and you hit enter and the bottom number says you owe $3,000, or your accountant phones you and says, hey Adam, you owe $3,000. Like I hate that. So if I know it's coming, that's fine. I don't mind that at all. I've created a tax plan. I know it's coming. And for myself, I know what my tax is every year. I do planning obviously around that. That's what I do for a living. So hopefully I do that well. But for most of our clients, there's a lot of uncertainty. And so I want to go through a client here. They're in their first year of retirement. They have multiple income streams. And they said, look, Adam, at the end of the day, we need net amount. So when we built out their plan, we had to figure out, with withholding tax and everything, all the moving parts, the amount that gets into their pocket, is it going to be enough? And a lot of this is out of our control and out of the client's control. And what I mean by that is when you pull money out of a RRIF or a LIF, there's withholding tax. And that withholding tax is based on the amount that you're pulling out. And so what happens, I'll use a RRIF as an example, a retirement income fund, which your RSP converts to a RRIF, and you start drawing out of that RRIF. If you convert, let's say in 2022 now, in 2023, you're gonna be given a RRIF minimum. So let's say that RRIF minimum is $10,000, meaning that you have to take at least $10,000 out of your RRIF in the calendar year. But let's say the plan has $30,000 coming out. That means it's $20,000 over the minimum. Typically, when you set up a withdrawal from a RRIF, or at least how we do it for our clients, is the minimum amount has no withholding tax. So the first $10,000 of payment to you is tax-free. But the other 20 that we're taking out, there's going to be a withholding tax. And any amount over $15,000 has a 30% withholding tax. So there's a 30% withholding tax on that RRIF withdrawal, but only on 20,000 of the 30,000. So this is where kind of the calculations have to come together. So I want to show you an example of a client that is drawing money out and how all the tax situation came together. So what we had to do for this client was figure out how much they're going to draw. So the wife's taking some money from the RRIF and the LIF, and the husband's taking money from his RRIF. So 30,000 and 2,000 from the RRIF and LIF, and then his RRIF is $60,000. What we have to do is take the account value at the end of the year. Now, obviously we don't know that, but we just use today's account value. Then we take their age to figure out their minimum RRIF withdrawal. So we figure out their minimum, and then anything above that is going to have withholding tax. So if I use his, for example, so 60,000, his minimum percentage is 3.57, meaning that his minimum RRIF payment for next year is $24,776. Now, he is going to pull out $60,000. So we've set him up on a $5,000 monthly gross draw, which means that he's withdrawing $35,224 over the minimum, which means that there's going to be a 30% withholding tax on that $35,000. So if we apply that tax, you'll see there'll be about $10,567 withheld, which leaves them a net pay of $49,000 and change, which again gives them a net monthly amount. So we've given him $5,000 gross, which net after his withholding tax is going to give him $4,119. Same with her RRIF. So if we go to her RRIF, $30,000, the minimum for the year is going to be $9,324. Again, $20,000 over the minimum, which has that 30% withholding tax. So again, the net payment from the 30 gross is going to be just shy of $24,000, and we'll draw that out monthly as well. Now, here's where it's a bit different, is with her LIF account, you'll see we're taking the maximum amount. So it's just a small LIF account. We're going to take the maximum amount out for the year, which is $2,000. The minimum for that account is $814. We're taking $1,100 more than the minimum. And because that amount, $1,100, is below $5,000, it's taxed at 10% withholding tax. So it's a little bit different. So any amount over the minimum between 0 and 5,000 has a 10% withholding tax. From 5,001 to 15,000 is 20%. And anything $15,001 above that minimum amount is 30%. So that's the breakdown. So what you need to do is figure out, okay, here's my account value at the end of the year. And I know we don't know that yet. And then search for, RRIF calculator based on your age. So pull up your age and the minimum amount you have to take out. And then figure out what the minimum amount is. And then go back and say, well, I'm taking out 60. The minimum is 25. So it's going to leave me with a $35,000 difference, which means 35,000 gets 30% withholding tax. And you can kind of figure out what your net payment's going to be. You can then add up your tax, which we've done for this client. So their total taxes withheld between their RRIFs and LIFs will be $16,889. Now, when we jump into their financial plan, we'll see that it's pretty close to their tax bill. Now, again, they wanted a net monthly payment of about $7,700. You can see here they're going to get about $8,000, so more than they were hoping or expecting, which means that when I talk to the clients, that we're going to owe a little bit more tax. So what we should maybe do here is adjust that non-registered withdrawal, pull it back from $1,750 a little bit, and then that will allow kind of the proper amount of tax and structure and all that to go forward. So this is how you want to map it out. Pull up an Excel spreadsheet, put in all your accounts, figure out what you're going to take out for the year, figure out what your account value, the percentage that you need to take out, your minimum, the amount above the minimum amount, and that's going to leave you with how much withholding tax percentage-wise and dollar-wise. And that's going to show you your net amount. And again, what you want to do is A, get an understanding of what the net amount in your pocket is going to be, because again, gross versus net is very different, obviously. Secondly, you're going to understand how much tax is going to be withheld. And you can do this for any type of account. If you have a pension plan, put how much it's paying you, how much tax is being held, and just start adding this stuff up. If the tax bill or the withholding tax is going to happen on all your accounts is fairly close to what you expect for a tax bill, that's perfect. And again, there's no real great retirement tax calculators online. There's tax calculators, but they don't take into consideration like age credits and pension income credit and a few other things. So I haven't found it. If you found a good calculator, please link it below in the comments. We love that. Again, we're here as a community to help each other out. So if you have a great calculator, link it below. We might eventually create something as well, but for now we don't have anything and I've never come across a good one. So if you do have a link to one, put it below there. We appreciate that. So there's your tax problem. And hopefully this makes sense. Like as you enter into retirement, you have a lot of income streams. There's a lot of moving parts and the tax situation is not going to line up. And you want to go through a process like this to make sure that it does line up. And if it doesn't, like let's say we ran this client, total withholding tax is only $10,000 and they owe $17,000. That's a $7,000 tax bill. We can talk to them about, look, like we need to build this into the plan. It's fine. We've created a tax strategy and it's fine that we have to owe that $7,000. And the plan there would probably be when tax time comes, when you get your tax bill, we're going to pull it from your non-registered account and we're going to draw back your non-registered monthly withdrawals now to make sure that everything lines up. Again, it doesn't mean that you're paying more tax than you should be. It just means that there's not enough withholding tax up front to cover your tax bill. The big difference between the two. So for this client, it worked out quite well. But for most clients, it typically doesn't. Like the first few years are very all over the place. And typically, there's more money withheld for tax, meaning that you're going to get a tax refund, which is great. Except for if they're withholding more tax, you need still the same amount net to you, which means that you need to pull more money out of your accounts in the first year or two until you get kind of a rhythm going. So just keep that in mind. Always look at not just your gross that you're pulling out, but the net amount that you're going to receive. So again, hopefully this helps you. And I try and create these videos once in a while that really walk you through the process of entering into retirement, the numbers, the psychology, kind of how it all comes together. And this is definitely a big issue that we run into. And again, there's not a lot of ways around it other than kind of filling out an Excel spreadsheet like this and just going through the task. And most of you have the ability to do this. Again, just pull up the spreadsheet, map out this. You can Google search, RRIF minimums for your age and all that. Like that's all online, easy to find. So just do the process yourself. It won't take you long, but it's going to give you that clear picture of what tax time looks like and if you're going to owe money or get a refund, just so that it's not a shock to you. So thank you so much for joining us in this video. Again, if you haven't subscribed to the channel, please subscribe. And if you enjoy these videos, hit the thumbs up and check out our other content on how to build a financial plan, how to do tax planning. We have a lot of content in our library on this, so check those out as well. Thank you. We'll see you in the next one.